Welcome back. Previously, we have discussed about almost all the equation and case studies and marginal costing. Let us discuss the second method for computing break-even analysis, that is a graphic method. So, today let us discuss about the second method for computing the break-even analysis, that is a graphic method for computation. Previously, we used various equations for finding out the break-even point, break-even sales, and break-even units. So, through graphic method, you can identify these values through pictorial representation. And break-even chart is the graphical representation of a break-even point or break-even analysis. It shows the relationship between sales, fixed cost, variable cost, profits, total cost, and from that graph you can easily identify break-even point without using any of the equation. The answer will be the same. Just if you use the algebraic equation, also you will get the same answer. Through the graph also you can easily find the same answer. So how you are going to prepare the graph? So before you are preparing the graph, you need to understand the concept of the graph. What are the contents of the graph and how we are going to prepare a graph. So these are the items that will be found in a break-even chart. So let us discuss each individual part. Every graph has two axes, x-axis as well as y-axis, and x-axis is represented by output or the number of sales amount if it is represented in sales amount, it will be in sales, or if it is represented in capacity means a concern that has a capacity to produce 10,000 units or 20,000 units. Likewise, output also remains the same and it will be represented in units. Likewise, so x-axis can be represented in output, sales, capacity, units, whereas y-axis is represented in cost and revenue. It may be either in representing sales revenue or it may be represented in cost. So that is the concept of x and y. And regarding next items, the sales line will always begin from 0 and it will be going towards an upward trend. Fixed cost line is drawn parallel to x-axis because fixed cost remains the same whatever the nature of the production. So the lines, remember and familiarize the lines. Variable cost is the line drawn from 0 point and it rises towards upward from left to right. So variable cost will be like this, sales will be like this, and fixed cost will be like this. Once you have plotted variable cost and fixed cost, you can easily plot total cost. That is, if you add fixed variable cost and fixed cost, you can easily plot total cost. Remember, total cost once you drawn, total cost will be parallel to variable cost. See, total cost will be parallel to variable cost. So you have almost plotted all the items. The point at which the sales line intersect with total cost line is known as break-even point. See, this point is known as break-even point. For the analysis at this point is known as break-even analysis. And the perpendicular line drawn from the point of intersection to the point of intersection is this. To the x-axis shows the break-even point in unit. If this x-axis is represented in units, we can say that the break-even point is in units. If it is represented in sales amount, it will be break-even sales. That depends upon the nature of the question. The perpendicular line drawn from the point of intersection to the y-axis is shown as break-even sales. Because here it will be either it will be in cost or it will be in revenue. That is the concept. So remember these properties of the break-even analysis and the various items that comes in a break-even analysis, because you will be given details regarding the sales, selling price per unit, variable price per unit, fixed cost, as well as number of units. So on the basis of details given, you need to prepare a break-even chart. And for that you need to prepare table that consists of sales column, variable cost column, fixed cost column, total cost column, total sales column, as well as variable cost per unit, selling price per unit likewise. So on the basis of those tables you have to prepare a graph, and details regarding preparation of graph is very simple. Just plot down all the details given in the question in a graph. I hope you know how to plot various points in a graph. Just go through the theoretical aspect mentioned in the text. If you have any queries, please let me know. And one more thing, this is a point is known as break-even point, and analysis of this point is known as break-even analysis. Every business try to identify this point and why, because from this once a firm identifies this point, they can easily achieve the same sort of earning a profitable business, because whatever activity above this point is known as profit, and whatever activity below this point is known as loss. So organizations who are able to identify this point can easily maintain a activity above this point. If the firm fails to identify this break-even point, they may accidentally come below the break-even point and ultimately they suffer loss. So every business try to identify this point so as to earn profits. So this point is known as no profit, no loss. Above this point, organization earn profit. Below this point, organization earn loss. So every organization's ultimate objective is to identify this point. And next one, angle of incidence. Angle of incidence is the angle formed at the point at which the sale line intersects the total cost line. See, this point is this angle. I hope you know what is meant by angle. This angle is known as this point. This angle is known as angle of incidence. So this is how a break-even chart is to be prepared. So just go through the theoretical aspects and try to work out some of the preparations of break-even chart. And angle of incidence, in most of the cases you need not have to plot down angle of incidence. You just understand the concept. Angle of incidence is the angle formed at the point at which the sales line intersects the total cost line, and it is the angle between the sales line and the total cost line at the point of intersection. It is the angle of at the break-even point. Angle of incidence is the indicator of the profitability of the firm. A large angle is an indicator of higher rate of profit, and a small angle is an indicator of lower rate of profit. Wider the angle of incidence, the more is the profitability, and vice versa. So angle of incidence can be widened by increasing the selling price or decreasing the variable cost. So here this angle is known as angle of incidence. Higher the angle of incidence is the dream of every business. So that is the concept of preparing a break-even chart. Next, margin of safety. Margin of safety is an important concept in break-even point, and margin of safety is the amount by which the actual sales exceeds the break-even sales. In other words, it is the excess of actual sales over break-even sales. See, this point is where break-even sales occur, and whatever sales over the break-even sales known as margin of safety. So every organization is trying to achieve a point above break-even point so that their margin of safety increases. Whenever the margin of safety increases, the organization is going towards the safest zone. So margin of safety is an indicator of profitability of the organization. Higher the margin of profit, margin of safety means higher profits, and vice versa. So Margin of safety is always otherwise known as safety position of the firm. A higher margin of safety suggests that firm can continue to make profit even if the sales fall considerably. A low margin of safety indicates that even a small fall in sales will put the firm into loss. So every organization and every business try to improve the margin of safety by increasing their volume of sales, by increasing their selling price, reducing the fixed cost as well as reducing the variable cost. And the equations for finding the margin of safety is actual sales minus break-even sales as well as profit divided by PV ratio, and these are the equations for finding margin of safety, and these equations can be used interchangeably for finding other items. So, and as a part of the activity, try to find the merits and demerits of break-even analysis as well as merits and demerits of marginal costing, and just go through the theoretical aspects. So let us go to the next area. Various cases. From the following particulars from the costing records of a concern: unit sold 10,000, selling price per unit is 30, variable cost per unit is 20, and fixed cost is 50,000. Calculate PV ratio, margin of safety, and break-even point, and calculate revised PV ratio, margin of safety, and break-even point when selling price is increased by 20. And finally, calculate the revised PV ratio, margin of safety, and break-even point when selling price is decreased by 10%. So let us find out the various cases. First one, let us identify the PV ratio. This is the most important information required for finding the other rest. PV ratio is contribution by sales into order. We have the details regarding sales and variable cost, so you can easily find contribution. So PV ratio is contribution by sales into 100, and contribution is sales minus variable cost. Sales selling price is 30 and variable cost is 20. You can either go with the per unit value or you can go with the sales value. For the time being, we can go with the sales amount. So 10,000 into 30, you will get 3 lakhs, and variable cost is 20 into 10,000, 2 lakhs. So you will get contribution 1 lakh. So substitute the same in the equation. PV ratio equal to contribution by sales into 100. You will get PV ratio 33 1/3%. 33 and 1/3. Remember, it is a type of a PV ratio representation. So we have found PV ratio. Next, you need margin of safety. Margin of safety can be computed by two equations, and we will be using profit by PV ratio. And in this case, profit is not given. You need to find profit. So for finding the profit, you need contribution minus fixed cost. We already found contribution. Fixed cost is also given in the question, so you can find profit is 50,000. So let's substitute directly in the margin of safety equation. Margin of safety is 50,000 divided by PV ratio 33.13%. You will get margin of safety. Once you have found margin of safety, break-even point or break-even sales can be easily found. Break-even sales is fixed cost by PV ratio. Fixed cost is 50,000, PV ratio is 33.13. So margin break-even sales is 1,50,000. And next, we have to deal with second part of the question. When selling price is increased by 20%, you need to find the rest, that is PV ratio, margin of safety, break-even point. So when selling price is changed, the contribution will change and the rest of the values also will change. So selling price, first of all, you need to identify the present selling price. We have the selling price 30. Present selling price is 30. So when selling price is increased by 20% is selling price plus 20%, you will get new selling price. And remember, one of the assumptions of the marginal costing was that variable cost per unit remains the same. So selling price per unit is 36 as it mentioned in the question. So total sales is 36 into 10,000, 3,60,000. So new contribution is sales minus variable cost. Sales is 3,60,000 minus variable cost remains the same. Variable cost remains the same means variable cost per unit was the same amount, that remains the same. So the variable cost amount also doesn't change, because here the only change is selling price, not the number of units. When number of units change, variable cost also will change. Here the selling price is the only change. So contribution is sales minus variable cost. New sales is 3,60,000 minus 2 lakh. New contribution is 1,60,000. So PV ratio equal to PV ratio remains. We will deal because come to the PV ratio part. Next one. New profit equal to contribution minus fixed cost. Contribution is 1,60,000 minus fixed cost. Fixed cost remains the same, whatever the production or whatever the activity. New profit is 1,10,000. Next one, new PV ratio is contribution by sales into 100. New contribution is 1,60,000 divided by new sales is 30,60,000. So new PV ratio is 44.44%. Next one, new marginal safety is profit by PV ratio. Profit is 1,10,000 divided by PV ratio. We already found 44.4%. You will get 2,47,000, 525. So finally you need to find out new break-even point. Break-even point is fixed cost by PV ratio. Fixed cost remains the same, 50,000 divided by new PV ratio 44.44%. You will get new break-even sales 1,12,511. So this is how you have to deal with the situation regarding PV ratio, margin of safety and break-even point computations. And finally the third part is find out the revised PV ratio, margin of safety and break-even point if the selling price is decreased by 10%. So try to find the answer for that one and giving that as a part of your activity, and try to identify the values. If you have any queries, please let me know. So we will go to the next part. From the following data, calculate profit when sales are 1,50,000. So let us go to the details. Break-even point 1 lakh is given. Fixed cost is 25,000. Break-even point is fixed cost by PV ratio. We know the equation. And break-even point is 1 lakh is given. 1 lakh equal to fixed cost is already given. So we can easily find PV ratio. So PV ratio is 25%. In the question it was asked to find calculate profit when sales are 1,50,000. So PV ratio we have, sales we have, you need only profit. So we know the equation. Sales equal to fixed cost plus desired profit divided by PV ratio. Sales is 1,50,000 and fixed cost is already given, and desired profit we don't know. PV ratio we already found. So substitute the details in the equation and you will get the amount 12,500. I hope you all guys are following the concept. Just go through it. Let us go to the next one. Profit volume graph, otherwise known as PV graph. And what is the concept of PV graph is? A profit volume graph is a graphical representation of profit volume relationship. The graph shows the amount of profit or loss at different levels of output. It helps to ascertain the break-even point also. The graph records fixed costs and profit or loss at different levels of output starting from 0 level. At 0 level of output, a company may make loss because sales will be equal to fixed cost or less than fixed cost, because at the beginning the fixed cost will be higher or the cost will be higher when compared to sales. That's why the activity of the business will be loss. As output increases, the loss decreases and becomes nil at the break-even point. And when the output exceeds break-even point, company starts to make profit. So you may think that the concept of profit and profit volume graph is almost similar to break-even analysis or break-even chart. Then why we are learning profit volume graph? In profit volume graph, it studies in detail the level of profit or loss at each level of activity. In break-even analysis and break-even chart and all, their analysis begins from 0. 0 means at the point where y-axis and x-axis meet. From that point only the analysis is happening. But profit volume graph is a point where the position of the business even before making sales is analyzed. So profit volume graph studies the relationship between whatever the volume of activity, and for each level volume of activity what was the position of the profit or position of the loss. That is studied in detail. That is the concept of profit and volume graph. And the graph, we can come to the graph part. A profit volume graph consists of x-axis as well as y-axis. And remember, y-axis is a elongated one that you overpass the intersection point, and this y-axis represents profit as well as loss, whereas x-axis represents the level of activity or quantity of sales. From 0 to upward, the position is a situation where the business earned profit, and the position below 0 is considered as the loss, a loss occurring area. So every business will be beginning their activity from this point because there will be no sales, but cost will be high, because whatever the activity, the initial cost will be the high and the sales will be much below than cost. That is why here the lines begins from this point. See, from this point line begins and it will gradually increases with the increase in activity, and one point it will overpass the 0 level, and once it overpass the 0 level and it starts to earn profit, and it will go on like that. And the point in which the line surpasses the x-axis is known as the break-even point. This point is known as the break-even point when compared to a profit volume graph. That is the concept of profit volume graph. And this area is known as profit area because the sales line will be going like this. This is known as profit area. This one is known as loss area. And just like the break-even graph, you have to prepare a profit volume graph also. Just like the break-even graph, it will also gives you different tables consisting of units column, sales column, variable cost column, profit or loss columns. So just go through the methodology and theoretical aspects in the textbook. Try to identify and draw out the graph stated in the text. This is the pattern and concept of the profit volume graph. Just go through the text, the table, and the computation is very easy. If you have any queries, please let me know. We will discuss in detail that part. So let us go to the most important area and the final area of marginal costing, that is application of marginal costing in decision making. This is the most important part in marginal costing, and it is an area from which most of the essay questions come, because it is actually points out the situations in which marginal cost can be used by the business in taking decisions. So, marginal costing and CVP analysis are of immense help to the management in decision making, which we have been explaining from the beginning. And segregation of cost into fixed and variable elements and the concept of contribution helps the managers to choose the best alternative. The alternative which provides the highest contribution is normally chosen. Remember that sentence. We will be discussing different situations. In each situation, the concept which we consider is that the main fact or the main point on the basis of which the decision is taken is done particularly on contribution concept as well as marginal cost. Whenever decision have to be taken with regard to cost, we all know that when it comes to cost, the main objective of business is to minimize cost. So whenever it comes to cost, remember the cost must be equal to marginal cost or it should be less than marginal cost. And when it comes to contribution, the activity which provide maximum contribution or more contribution is considered to be the best alternative. Just remember the fact. We will discuss in detail each individual part. First one, fixation of selling price. Fixation of selling price means fixing the price for a product. And you may think that it is one of the easiest method, then why we are using marginal cost for such an easy activity? Because under normal circumstances, the total cost forms the basis for fixation of selling price, and it is very easy to set the selling price. The price is fixed in such a way that it covers the total cost and yields a margin of profit. But under special situations or under special circumstances, that is during business recession or severe competition, such situations the management need to take proper decisions, and during such situations marginal costing help the organization in taking the proper decisions. So under these situations the price will have to be fixed below the total cost. So how far we can go to minimize the cost of the product? So right now the question arises that to what extent the price should be reduced. The normally followed principle is that the selling price could be reduced to such a level that it covers at least the marginal cost or variable cost. Sometimes the price may be reduced even below the marginal cost, but the basic rule regarding fixation of selling price under special circumstances is that one can reduce their price till marginal cost. Below marginal cost, it is very dangerous for the organization to minimize the price. A concern can minimize its price till marginal cost. Beyond that, it is very dangerous. And we will discuss about that part. And what are the various there are a number of situations in which fixation of selling price comes. Usually it may be whenever a new product is introduced in the market, when a foreign market is to be explored. Sometimes products are sold to a special type of customers, and then even there are some situations in which it will not be possible to close down the business temporarily. There are many numerous cases in which the business might require the help of the marginal costing for setting the selling price. So a case regarding that, ABC Limited is working below the normal capacity due to the adverse market condition. The present sales and cost of the firm are: normal capacity is 5,000, actual output is 3,000. And remember this normal capacity and actual output. Never ever the actual output exceeds normal capacity. Always the actual output will be equal to normal capacity or less than normal capacity. It will never surpass normal capacity. Okay, fine. Next one, direct material is 30,000, direct labor is 12,000, variable overheads is 3,000, and fixed overheads is 25,000. So selling price per unit is 20. The company has received enquiries for supply of additional units below the current market price. Suggest the minimum price to be charged for the additional units of product. So we all know the minimum price can be till marginal cost, but till marginal cost means you have to make sure even after reducing the price till marginal cost, whether the organization is earning benefit. For that, you need to prepare a marginal cost statement. So let us prepare a marginal cost statement, then you will understand the concept of fixation of selling price under special circumstances. So on the basis of details given, we can calculate the marginal cost per unit. Marginal cost per unit is total marginal cost divided by number of units, and we can easily find the total marginal cost. Just add together all the variable expenses divided by number of units. It is already given in the question. Number of units means number of actual units. You will get marginal cost per unit is 50. So you can reduce the price till 15. Beyond 15 is not good for the organization. So that is the concept of taking decision regarding fixation of selling price. So the minimum price to be charged is 50. Any price above marginal cost will reduce the present loss by recovering the fixed cost. That is the concept. So minimum price which can be set is ₹50. So this is one of the application of marginal cost in decision making. Next one, acceptance of foreign orders or special orders. As a businessman working in the dynamic business external environment, sometimes businessman may get offers from foreign concerns regarding various orders, or sometimes some special orders may be acquired from outside parties. So for a businessman, such orders are good for the business, but there is an issue regarding that. Whenever bulk orders come from outside parties, these outside parties demand some sort of reduction in price or cost. In that situation also, you need to consider the marginal costing concept. So acceptance of foreign order or a special order. Sometimes order may be received from foreign buyers for a price less than the price prevailing in the domestic market. So normal man may think that while accepting foreign orders at a price below the domestic market price cannot be acceptable, but there is one hidden benefit in that. Such orders could be accepted if the price quoted is above marginal cost and thereby providing some contribution, because the firm selling at a profit in the domestic market already covered its fixed cost. So they are actually in a safe position. So any contribution received from the foreign order is fully towards profit. That will add to the overall profit of the organization. Thus, acceptance of foreign order improves the overall profitability of the firm. However, while accepting order, it should not be accepted if the price quoted is below marginal cost, because if the price quoted is below marginal cost, it will not be beneficial for the organization. So orders received from special customers like government departments can also be treated in the same manner, but remember, their price never go below our marginal cost. So let us discuss the same with an example. XYZ Limited is working at 70% capacity, producing 7,000 units. Okay, they are producing at 70% capacity, that is 7,000 units. They can add or they can increase a production of another 3,000 units also. Direct material 21,000, direct labor 14,000, variable overheads 14,000, fixed overheads 20,000, selling price per unit is 10. Company receives a foreign order for the supply of 3,000 units. State whether the foreign order can be accepted or not. And there is a missing in the point that the foreign order is received for 3,000 units at ₹8. Our selling price was 10. Do we have to accept that order for ₹8? Whether by accepting that order increases the profitability of the concern. That are the factors that has to be considered while taking the decision regarding acceptance of foreign order or special order. So in order to find the profitability earned before and after, you need to prepare a marginal cost statement. So let us prepare the statement on the basis of present working condition, that is before accepting the order. So at 7,000 units, direct material per unit was rupees 3. I hope you know how to find 3, and direct labor is 2, and variable overheads is 2, and fixed overheads remains the same. So the marginal cost statement will be like this: sales is 7,000 into 10, 70,000, less variable cost 21,000, 14,000, 14,000, directly given in the question. If we add together these three amount, you will get 49,000, and if you deduct 49,000 from 70,000, you will get contribution during the period. From contribution, if you deduct fixed cost, you will get profit. So right now the business is earning a profit of rupees 1,000. Whether accepting 3,000 at a price lower than the selling price generate any benefit to the business. So let us prepare another marginal cost statement based on the new activity. Sale is 7,000 at rupees 10, because 7,000 units were sold for rupees 10 in the domestic market. We received order from the foreign company concerned, so let it be 3,000 into 8, because they said that they want to give some orders for 3,000 units if the price is quoted at 8. So let it be 8. So total sales from the entire activity of the concern or entire sales is 94,000. And from 94,000 you need to deduct the direct material, direct labor and variable overheads. Remember, earlier it was 7,000 units, now it is 10,000 units, 7,000 plus 3,000. So the variable items will also change, because variable cost per unit remains the constant. So direct material is 3 into 10,000, 30,000. Likewise, direct labor 20,000, variable overheads 2 into 10,000, 20,000. So you will get 70,000. If you deduct 70,000 from 94,000, you will get 24,000 contribution during the year. See, we have got extra 4,000 as contribution, and if you deduct say the fixed cost from that, you will get profit of rupees 4,000. See, earlier the business was earning 1,000 rupees as profit. Now if they accept the foreign order, they can easily earn 4,000 rupees, extra 3,000. So what will be the decision? So the decision is accept the foreign order so that the organization's profit can be increased by 3,000. This is how you need to take the decision regarding marginal costing application for accepting foreign order or special order. Okay, let us try another method. Make or buy decision. As the name suggests, it means whether you have to make a product or whether you have to buy the same product from the market. That is the meaning of the sentence. And the concept of make or buy decision is the decision regarding make or buy is based on the marginal cost of producing the component or a part and the price quoted by the supplier. If the marginal cost is lower than the price quoted by the supplier, the component should be produced in the factory. On the other hand, if the price is quoted less than the marginal cost, it is better to buy the component. That is the concept of buying or producing a product within the concern. I hope you understand the concept. For example, if I am a businessman, I am producing a certain raw material for a product, and if the price of producing that raw materials is 10, if the same raw material is available in the market at a price less than 10, then what is the best option for me? Whether I should produce the same product for rupees 10 or I spend rupees 8 by purchasing it from the supplier. Naturally, I will buy from the supplier because for me it is an extra rupees of 2 incurred so as to produce. So it's better to buy from the supplier. That is a concept of make or buy. So in whenever cases come, you just need to identify the marginal cost for producing the product. And if you get a price lower than the marginal cost in the outside market, just go and buy that product. Otherwise, you could just produce or manufacture the product. That is a concept of make or buy. We will discuss the same with an example. Before we go into that, the concept is if the marginal cost is less than the price quoted by the supplier, definitely make the product, because it is better to make the product rather than paying more amount to supplier. If the marginal cost of that particular product means usually it will be relating to a spare parts or a component like that. If the marginal cost is greater than the price quoted by the supplier, definitely go and buy from the supplier. It is better that way. So let us try an example. Following are the cost details of a manufacturing of a component part, and direct material is given, direct labor, variable overheads, fixed overheads, and total amount is 40. So here we are removed B and the product related to A and details of product A and details of product C is given. See, A is 10,000, variable cost 6,000, so the contribution is 4,000, and for C it is 25,000, 12,000 and 13,000. And remember, total fixed cost is 7,500. The thing is, whatever the activity going on in the business, the fixed cost total never change. It will remain same for whatever the activity of the organization. So because of removing B, there is not much contribution to cover this fixed cost. See, in the case of B, the contribution was around 7,000. Because of this 7,000 only, fixed cost was almost covered to a negligible value. So without B, the entire fixed cost has to be suffered by A and C. So the net profit, the organization suffers a loss of rupees 500. So the mere glance of the first statement, you can see that the business has earned a profit of 6,500. So if they remove B, they will earn 7,500. But when the detailed analysis, we found that if we remove B, the business will earn a loss, will suffer a loss of rupees 500. This is because the B was earning a considerable amount of contribution, and that contribution was able to cover the fixed cost. That is why Whenever the B was, even though B was running in a loss, because of the B product, the organization overall profitability was 6,500. So this is an important factor that has to be considered while taking a decision regarding discontinuing a product or a closure of a product. And finally, alternate method of production. Production may be undertaken by manual work or a mechanical work. If the case of mechanical work, different types of machines are available for production. The management should decide which profitable method of production has to be followed, and the method which gives the highest contribution is normally selected for the process. So it is one of the easiest method of taking the decision, and we will discuss with an example. Product X can be produced either by machine M or machine N, and machine M can produce 60 units per hour and machine N can produce 90 units per hour. Total machine hours available during the year is 4,000. So from the following data, which is more profitable? So the details are: selling price per unit 25 for each product, marginal cost per unit is 15 and 17, fixed cost per unit is 5 and 5. So what is the difference between a machine M and machine N? Which one is better? So let us find out. Selling price is 25 and 25, same for the machine M and N, but if you deduct marginal cost from both machine M and N, you will get a contribution 10 and 8. Contribution of machine M is 10 and contribution of machine N is 8. But in the question it is said that total hours that can be provided, means the output per hour for machine M and N is 60 units and 90 units. In that case, the contribution per hour will be 600 and 720, because contribution per unit is 10 and the machine M can produce 60 units per hour, so the total contribution will be 10 into 60. Here similarly it will be 720, and in the question it is said that total machine hours available during the year is 4,000. So contribution per hour is 600 and there are 4,000 working hours. So machine hours is 4,000 for each, then the total contribution will be 600 into 4,000 and 720 into 4,000. If you go through the total annual contribution, you can see that machine N is having the highest contribution when compared to machine M. So we will go with machine N. So on the basis of all these points, the concept is that when it comes to profitability or contribution, whatever the activity that provides maximum profit or maximum contribution, that activity is selected. So when it comes to a decision regarding cost related aspect, whatever the activity that having the minimum cost or cost up to its marginal cost value is selected. So that is a basic concept for taking decisions regarding the applications of marginal cost in managerial decision. So these are the all areas that has to be considered. So just go through all these areas and we will discuss about various points in the coming sessions and try to familiarize all the problems and cases. If you have any queries, please let me know. That's all. Thank you.